Thank you so much for tuning in to our live event, the playbook to home ownership. I'm Richard Kirby. I'm a licensed realtor here in the state of Texas, and I have my lender partner with me, John Muhammad.
Hey, I'm a licensed loan officer here in the state of Texas.
Excellent. Well, today, first of all, let me start out by saying this. I am a licensed realtor in the state of Texas. My license number is 0644734. I just want to make sure that we stay TREC compliance. Also, because this is a live event, feel free to ask questions at any time through the event in the chat room, okay? So we're going to go ahead and get started right now. And again, you can ask any questions that you want in the chat room, and we'll try to get to them as soon as possible, okay? So again, first of all, let me congratulate you on taking the first steps to home ownership. I know this is a big deal, and of course you've probably heard a lot of different information about how the market is moving and things like that, and so getting all the education that you need to be an informed buyer is going to put you in the best possible place to win in the fast market that we're in. Wouldn't you agree, John?
Absolutely. And so also as Kirby mentioned, he's a licensed realtor here in the state of Texas. I, again, am John Muhammad. I'm a loan officer, and my license number is 1498175. I am a specialist, Richard, when it comes to helping people get into a home. I work
Absolutely.
with a lot of first-time home buyers.
Well, that's why I chose you.
Thank you. Having 20 years of experience in the mortgage industry has helped me to really perfect what I do and to be able to help others. And so having a passion for home ownership and to help people succeed, I think one thing about the two of us, we'll take you wherever you are and help you get there, whether that's next week or a year from now. So
I think that's what I love about working with John is that we never tell anybody no.
Right.
We may just say there's a couple things that we need to work through first, but we're going to get you there. So, again, that's why we call it the playbook. We're going to give you the information that you need to be successful in this market, in whatever market comes. And like you said, whether that's right now, whether it's 6 months from now or a year from now, we're going to give you what it is that you need. First thing we want to talk about a little bit is about just renting versus buying. And Maybe, John, maybe what are some things that you think of the big advantages that you would say when it comes to buying versus renting in this market?
Well, you'll never become or gain from being a renter. That's number one. You have to get in the game. And Kirby, you and I are aware. Just a personal story. I bought my most recent home in 2018.
Yep, I was his realtor, by the way,
for $330,000, and today my house is worth $550,000. I don't know that in 3 years that you'll gain equity in that way. If you're not in the game, you're not a homeowner, you're never going to get that advantage. Kirby, since I purchased that house in 2018, I've refinanced it twice.
Wow.
My payment didn't go up, it went down. Every renter that I've ever talked to has told me their rent has done nothing but go up. I don't think you can renegotiate down on rent.
No, rent is always going to continue to go up every single year. So one of the first things, I'm sure a lot of people, they always come to us and they want to know what's the first step to home ownership. And then, you hear different phrases thrown around like pre-approved versus pre-qualified. John, let's talk a little bit about what a pre-approval is and why buyers actually want to be pre-qualified, especially in a fast-growing market like we got today.
Yeah, so there's a lot of conversation in our industry regarding pre-qualified versus pre-approval. And this definition has changed, in my opinion, over the years. A lot of folks in the real estate world look at a pre-qualification as it's a letter given to someone who has been verified by a loan officer. So as an example, if someone provides me with all their paperwork and their W-2s, bank statements, etc., I run them through an automated underwriting system and it kicks out an approval.
Okay.
So that is, in my eyes, a pre-qualification, right?
So they're ready to go.
They're ready to go. But then there's a step further they can go to become pre-qualified or pre-approved, I should say, in a way that not only has it been verified and checked by me, but then checked by the underwriter, right? And so when you're dealing with loans, the loan officer is able to qualify someone, but the underwriter, the human being, takes it a step further and certifies it. And so that's where we are. You want to be pre-approved, meaning you want to have had your loan looked at by an underwriter to verify that they agree that you can be approved.
Okay. In the next slide, John, I want to kind of come back to that a little bit because I want people to understand what a pre-approval will do when we're dealing in an extreme seller's market where we are versus just being pre-qualified. So that will make a big difference.
Yep.
So, okay, so what you're saying is once they're pre-approved, now underwriting and everything has checked everything and they're ready to purchase a home.
There's no need for a finance contingency.
Okay. So
that makes the seller feel very, very comfortable that you're ready to go.
Okay.
So we remove that step up front.
I like that. So what I'm going to do, John, I'm going to kind of talk a little bit about helping everybody understand the market. And again, feel free to, if you have questions about pre-approval or pre-qualified, if you got questions, feel free to put that in the chat and we'll definitely, answer those questions a little bit more in detail for you if necessary. Understanding the market. You typically have two markets that we're in, or you could have a balance, but mostly you're going to have either a buyer's market or a seller's market. Right now, we're in what we call an extreme seller's market. Yes. And so what that means when people are throwing around that term is a seller's market is when you have less than 6 months of inventory. So if you have less than 6 months of inventory on the market, that means if no one else listed their house to sell, that we will have enough houses to only last us 6 months with the amount of buyers coming in. Right now, we're in an extreme seller's market. So if you're looking like Mansfield, a lot of areas in Dallas, we have 0.6 of a month, so less than a month worth of inventory in the DFW Metroplex. So you can understand there why you're going to have a lot of competition for the houses that you may be looking to purchase. So that's why I think having the pre-approval, that's why I want to kind of come back to you there, having the pre-qualified versus pre-approval, because in this extreme seller's market, we're going to need to be able to move really quickly and close quickly. So if they're
Right.
pre-qualified or pre-approved, which one will give them the best opportunity to win in this
A
market?
pre-approval, right? A
Okay.
pre-underwritten loan, and so that pre-approval will be transparent to the seller or the seller's agent because you as a realtor don't have to ask for a finance contingency. And when you don't have to ask for a finance contingency, that is as good as cash.
Good as cash. So I love that. So one thing that I want to point out there, John, is a normal buy cycle, if you will. Let's just say, like right now, let's say it's April 10th.
Mm-hmm.
So if we put a house under contract on April 10th, the normal close date will be May 10th, right?
Correct.
Normally it's about 30 days.
Yeah.
But in the event that you already have all their documentation, how much faster can you close that loan?
14 to 21 days. We will need two things: title and an appraisal.
Title
Right?
and appraisal.
Title and appraisal.
So being able to close a loan in 14 days could make a huge difference to that seller. And again, like you said, when there's no finance contingency, they know that you are all the way qualified and the cash is available.
Mm-hmm.
So we know, most people know, you've heard the term cash is king.
Cash is king.
Well, it's the same thing in real estate. So we're going to move on to the next one here. I want to let you know we do work with builders because the market has been the way it is. And as we talked about it being a seller's market, there's not a lot of inventory. So we work with a lot of new construction homes. You definitely want, of course, when you go into the model home, you know, they're going to have the model all fixed up. It's going to be nice and beautiful, but they're going to have a sales counselor there. What you need to understand is that sales counselor actually works for the builder. That sales counselor does not work for you. Also, that sales counselor is going to have a relationship, or that builder is going to have a relationship with a particular lender that may give you some different incentives. But again, you have to understand they're in partnership. So for me, you always want to have your own representation. It doesn't cost you anything to have a licensed realtor with you or to continue to work with John throughout that process, because we represent you and we always going to have your best interests at heart. Anything there, John, you want to throw in on that?
Yeah, no, I mean, you hit it on the head. These things that these builders are doing, it's because they're in a business relationship with their lender partner.
Absolutely.
and that's okay, but who's representing you? And I think there's a fallacy that because it's new construction that it's all right.
Oh, no.
Right. They don't. Some people think they don't need to get an inspection. They think that the house is going to be perfect. Everyone's not on your side, and you just have to to really realize that sometimes by stepping out away from their entire process, because some builders want you to do insurance, they want you to do title, they want you to do every single aspect of the real estate transaction with them, and that's just not always the best thing for you. So absolutely, and then sometimes we're able to compete with their offers, right? And so we look at that, and at the end of the day, I think for you and for me, we're going to do what's right for a person. We're going to tell them, hey, if it makes sense to do it, then do it, because the goal is home ownership.
Absolutely, and that's what we're serious about, is getting as many people into homes as possible. That's why we host these first-time home buyers events, to make sure that our community is well educated in the home buying process. So the next thing, and we'll kind of come back to it, let's go to the next one. We want to talk about a little bit about the upfront costs that it takes to purchase a home. You know, you've probably heard terms like option fee and earnest money. You've heard John mention a couple times about appraisals and things like that. And even when we just talked about new construction, we mentioned the inspection process. A lot of times on new construction, people think that it's not necessary to get their home inspected. And I'm here to tell you that, yes, you always want to hire a licensed inspector that works outside of the builder. So let's talk about the first term here, which is option fee. Your option fee is basically, what that basically is we're putting some money down to give you an opportunity to have the home inspected. We're putting a contract on the house, but we have an option period, which is normally anywhere from 5 to 10 days, where you can get the home inspected, and then you're still able to bag out in the event that you find something that is not up to par on the property. The second term that we have here is going to be your earnest money. Earnest money, to me, the best way to describe that, and John, if you got another way to describe it, I describe it as like a deposit.
Yes.
Right. So this is a deposit. This money that you actually get back is still your money. You get it back at closing, but normally it's going to be about 1% of the total price of the home. So in the event that you purchase a home that's $300,000, your earnest money is going to be $3,000. So anything on that?
Yeah, I mean, I think, Kirby, one of the things that you and I do is we keep it real with people. And I hear folks say things like, you could buy a house with no money down. It is just not.
It's not the truth.
It's not realistic. You will always have fees. There's no way around that. I don't care if it's new construction, if it's buying a pre-existing home. I should say there's always an exception. In our world, there's an exception to everything. Right. Maybe if you get a family member to sell you the house, you could put $100 down, and you could really do it with no money down. We've done that, right? So, but in general, you're going to need some money.
So you're going to have some out-of-pocket costs. Now, we have closed many loans where people have got money back at closing, but again, there was still these upfront costs, which is your option fee, your earnest money. Then, like we said, you're going to hire a licensed inspector. Typical inspection could run you anywhere in this market from about $400 to $650, depending on the size of the home, if it has pools or if you're doing termite inspections and things like that. And then your appraisal fee. The appraisal fee is paid to the bank. Basically, what they're doing is they're making sure that you're not overpaying for homes in this market. They're going to give you direct value.
And I have to be honest, and to make sure that we're not over lending.
Yes, that's what I mean. Yes, over-lending.
Exactly. So, but all of these things, option fee, earnest money, appraisal, these are not additional fees. These are a part of your closing costs. So you're just sort of paying it up front. So if you put up $3,000 of earnest money and you pay $200 in option fee, that $3,200 is going to go towards your closing costs.
And that's an excellent thing. So you do get that money back. We're going to go on to the next slide. This one, I think, is a very valuable slide. We kind of touched on it, briefly when we talked about new construction and people in this market. You're seeing a lot of people want to skip the inspection period. I'm never going to recommend that you skip the home inspection, but ultimately that's your choice. My job here is to educate you the best that I can, but there's different things that can be happening. Your deal breakers, which are going to be typically foundation, roof, electrical, plumbing, AC, those things could be deal breakers. However, a lot of things can be negotiated throughout the process of that contract. So definitely, we will always advise you to do a home inspection.
And always get it done. I just I have a couple of stories, right? Because sometimes this is the biggest investment you're making in your life. Absolutely. Is purchasing a home. And so if you skip steps trying to be cheap, it may end up costing you, because guess what, Kirby? There is no return policy on a house.
Absolutely.
Once you sign the paperwork, it is your house. There is no return policy. You don't have 30 days. I've actually had someone call me and tell me, like, I would like to return my house.
It doesn't work.
It cannot happen.
That's right.
But if you don't get your home inspected and something comes up, a plumbing issue, you can't go back and blame the seller because you didn't have it inspected. Absolutely. So you have to protect yourself. You have to protect the biggest investment that you're making in your lifetime. Spend that extra money.
No, I think that's great advice, because, again, you cannot return it. So last thing that I want to say right here, we've kind of flowed through this information quickly because we want to be mindful of your time. But at the same time, we want to make sure that if you have any questions, feel free to put them in the chat. We're going to address those. And then even after we finish with the slides that we have, we're going to be available 15 to 30 minutes even after we finish with that. So if you have some further questions or anything to ask at that point, we'll definitely answer those questions for you. So now we're going to get into this is the money. This is why I brought John Muhammad in today, because John, he's been doing this, like he said, for over 20 years, and he's developed his concepts. He calls it the 4 funnels of finance. He is a mortgage wizard. So I want John to kind of, walk him through your 4 funnels, John, and go from there.
Perfect. Well, definitely. all these things are equal. I look at the 4 funnels of finance not in a particular order, but whenever you're baking or cooking, the recipe is the recipe.
I never cooked. I got you.
If you're missing baking soda or baking powder out of your recipe, look, it don't matter what else you got. But these 4 particular categories are necessary in the home ownership process. I talk about them in a particular order as I think through it. But income. So we always have to have a 2-year work history. You as a buyer have to have 2-year work history somewhere in your career. Doesn't mean you had to have worked at one job for 2 years. Just need a 2-year work history. If you are a W-2 person, it's very easy. I don't need your tax returns if you're a W-2. Nice. And your income is very easy to calculate because we just look at your W-2s, your most recent pay stubs, and we sort of determine what your income is. It's a very simple calculation. For those of you, Kirby, who's self-employed.
I'm actually purchasing through John right now.
So self-employed, guys, I implore you as a self-employed person to understand that it's not how much money you gross or how much money you can say you made. It is what you pay taxes on. That is as simple as
documentation.
It can be.
Documentation every time.
Right, every time. Because look, when I look at that tax return, yes, it may show that you made $200,000 on your Schedule C, your profit and loss statement. But when I look at line 31, whatever you pay taxes on is your income. But I don't want those of you who are self-employed to think that maybe you didn't file it right, you didn't get good advice. There are some options, such as a bank statement loan, where we just look at the cash flow in and out of your account, determine what that income looks like, and then we derive your income from there, but that takes 20% down. There's always, in most cases, a solution somewhere.
Let me stop you there, yes. John. So I know it's probably going to be a lot of questions. Every time we do seminars like this, we get a lot of questions when it comes to the financing and work history. So again, put those comments in the chat and we'll definitely, get those answered. So John, Absolutely. If you want to, keep going through that.
Yeah. So part-time jobs, overtime, things like that. Then what happens is that we look at that on a 2-year average. It's okay that you have a part-time job, but you have had to have been working it 2 years along with your primary job, right?
Gotcha. So if I'm waiting tables in the evening or driving Uber or something like that, you can count it. I just have to have documentation that I've been doing it for at least 2 years.
Along with your primary job. If you're receiving child support, we can count it as long as your child is under 16 years old, right? It's always projecting forward, like what is it? Is this income likely to continue? So they have these stops in place. So disability, any type of income like that can be counted. And I think that's important for a lot of people to understand that child support and things like that can be counted. So second thing I'd like to discuss is credit. It is important that you understand you need credit to buy a house. If a mortgage company is going to loan you $300,000, which is almost where a starter home is today, $300,000.
Absolutely.
If a bank's going to loan you $300,000, they want to know that you're going to pay them back. It's just the nature of it. Yes, we can help folks who have a 580 credit score. It's a low score. It's going to be a very tough proposition. It's going to be frustrating. It's going to be restrictions.
More documentation.
Less in your debt ratio, which I'll discuss in a moment. So less room in your debt ratio. It's going to be challenging. Your interest rates are going to be high. So ideally, you want a 620 credit score.
Okay.
If you can get to a targeted score of 620, all doors open. You're going to be able to get down payment assistance if you need that. You're going to have access to most of the mortgage products. But, of course, the higher, the better. Higher credit, the better. And let me tell you this. I'm going to take a moment, Kirby, and tell you what we always talk about.
Is it credit
karma is not your credit score.
Gotcha.
It is your credit card score, right? Gotcha. Credit Karma is free because they are marketing credit cards and services. When I need a credit card, I go to Credit Karma because I can punch in. Like I was looking for a Southwest airline credit card because I'm taking a trip. So I just go into Credit Karma, plug in Southwest, and it tells me very good chance I'd be approved. That's how I use Credit Karma. it's an indication, no doubt, of your credit score. But trust me, folks, what you see on Credit Karma is not what I see.
What would you say, John? I typically tell people it's probably 40 points or so difference, or what
I
do
think
you
20 to 30 points
Okay.
lower in most cases, right? And I'm in that most case. My mortgage score is higher than my Credit Karma score. Don't know why that is, but it's an indication. If you really want to know, folks, where you are and you don't want a hard inquiry, go to myfico.com, myfico, do the $29.99 plan, and you'll get a chance to see what your mortgage score is. So all of these things are important. Things that I'd like to tell you about that you can do without creating a lot of new debt if you're trying to boost your credit scores. There's a tool out there, Kirby, called Rental Karma.
Okay.
Rental Karma will go back and report for up to 2 years your rental history and put that on 2 credit bureaus, building up your credit without creating new debt. Of course, they charge for these things, yes. Experian Boost. Take your cell phone, take your utilities, take some type of bill that you're paying that doesn't generally report to your credit report, and use Experian Boost to put it on there. Okay. That's something that can help. Self-lender, give yourself an installment loan. You put up $300 or $500, and then they lend it back to you, and you make a monthly payment. This isn't creating
so it's
new
kind of
debt.
like a secured. Yeah.
It's almost like a secured loan. A personal loan. There's just so many things that you can do. And then, lastly, I'll kind of close out on being an authorized user. Okay. If you have someone who has a good credit card, meaning that like it's been open for several years, the utilization is low on it, they make on-time payments, have them add you to their credit card and then get yourself a secured credit card. That is a way you can build credit without going out and creating a lot of debt.
It's also a great way to get your kids, maybe your college kids or people like that, started in credit.
No doubt. No doubt about it. And stay away, folks. Stay away from payday loans. I don't care what those people tell you and that it's helping you build credit. It is not. It makes it look as though you cannot handle your finances.
That's good.
It's an underwriting problem. Number 3, money. I mentioned it a few minutes ago. Anytime you buy a home, you need money. You are going to have some money. Doesn't mean you can't get that money back, but you got to have it in the beginning. Mm-hmm. You need earnest option appraisal in the beginning. And in most cases, that's going to be around $3,500 to $5,000. Just depends on how much earnest money you have to put down. But it is a possibility that you can get it back if there's seller concessions or things that happen throughout the process. But in most cases, you have to be willing at minimum to invest $5,000. Gotcha. Could be a little bit more. There are down payment assistance programs that will give you anywhere from 3, 4 to 5% of your loan amount as a grant. Your obligation to them is that you keep the loan for 3 years in most cases and that you don't refinance or sell the house. But you can also pull from your 401k. A lot of folks don't know that. The 401k allows you to pull your money out for the purpose of purchasing a home. It's called a hardship loan.
So is that any penalty on that? Or?
Please talk to your tax advisor.
Okay,
but
gotcha.
I know they'll let you take the money for sure.
Okay, gotcha.
A family member can give a gift, and that can be your down payment. That can be your closing costs. So,
is it a limit on the gift that they can give? Or?
No. You can give as much money as needed. I've had a family member give $100,000. I think that's about the highest one I've seen. But they can give as much as they want. That's pretty good.
That's a good family member.
Again, IRS refunds this time of year, right? People have refund money going. The thing about money that you're using for the purchase of your home, it has to be verifiable, meaning it has to come from a source we can get information on, like a family member. We're going to ask them for a bank statement. But here's the one thing that doesn't work, Kirby, and that's money under the mattress. That's money at home. You have to save your money in the bank, folks. Have to save your money in the bank.
No mattress money.
No mattress money. Mm-hmm. We're going to go back and verify your account for 60 days.
Okay.
So if you got some money sitting in your shoebox, in your closet, put it in the bank. Get ready, all right?
I see the questions on chat coming. I see the questions on chat coming
about
the mattress money.
Put that money in the savings account.
Okay. So
So fourth thing, y'all, that I'll discuss is called debt ratio, your DTI. You'll hear that when you're buying a house, your DTI. So what your DTI is, it's all of the payments that are on your credit report. We don't look at balances per se. We do if we're trying to exclude something. So as an example, if you got less than 10 payments left on a particular debt, say it's a car payment, we might be able to get around that. But in general, we're looking at the payment that is on your credit report. What are you paying for your car? It doesn't matter if you owe $10,000, but you owe $10,000, but your payment's $900. We have to count $900 in your debt ratio.
Gotcha.
Whereas if you owe 10 on the car and your payment's $200, well, we're counting $200. So it's everything on the credit report. It is the mortgage payment, the potential mortgage payment. We take those two things and divide them into your gross monthly income, and that determines your affordability. But let me tell you this, what I get questions on often are things like child support. Yes, child support counts. We have to count that in your debt ratio. Though it may not be on your credit report, we have to count it. Student loans, I hear it and have been hearing it since COVID for the last 2 years. My loans are in deferment. My loans are in deferment. Well, the mortgage companies are looking at the next 30 years because their relationship with you could potentially be that long. They're not looking at the now. So in most cases, we're having to count 0.5%. So if you owe $100,000 in student loan debt, we're counting a $500 payment against your debt ratio.
Okay.
If you have collections, I see a lot of collections out there, maybe from an apartment that you left and you felt that you left it intact and they feel otherwise. And now they're charging you $4,500 as a collection and you don't feel that it's justified in paying. Well, if that's the case, if it shows as a collection, we have to count that in your debt ratio.
Wow.
So at a 5% payment, even though you're not paying it. So those are the things that you should know. So we're going to look at that. But here's what doesn't count. Charge-offs and medical bills. I talked to someone recently, had a $45,000 car charged off. Doesn't matter. Doesn't matter as long as it's charged off. Now, if that $45,000 would have been a collection, it'd be 5% payment against it.
Let me say this too right here because again, he's going through the 4 funnels of finance, and everybody's situation is always different, right? So the best thing that we can do is always get you in. Let's look at your individual situation.
Always.
So feel free, if you're ready and you want to raise your hand now and say that you're interested in us looking at your individual situation so that we can get you started. Because right now, of course, we're speaking in generalities, right? And so everybody's situation is different versus if you have a 580 credit versus a 720 credit, you've been on your job or self-employed, whatever that is. We want to look at your unique situation to make sure that we're giving you accurate information. So right now, this is
a general overview, and we can go on and on. But I had a story from yesterday as an example. I had a client call me, and they said, "Hey, John, I'd like you to take a look at my situation. It's like I have a pre-approval that I'm just really wondering, can I qualify for more?" And I asked the buyer, I said, "Who's your loan officer?" And it happened to be someone I know. And I said, "Well, she qualified you." In my head, I'm thinking, she qualified you. I know it's probably solid. So I said, "Good, certainly I'll look at it." He applies. From the eye, when I looked at the file, I said, "Well, she's on it. Like, she's probably on it." But I took it a step further and picked up the phone. And I started talking to the client about his debts. Turned out there were 3 car payments on his credit report. One of those cars had been paid off in the refinance of another. But guess what? That $500 payment was still sitting on the credit report. So someone who doesn't take the time to really do what you're talking about, which is consult and have a conversation, she missed that. And I was able to eliminate a $500 payment and take him up $50,000 more.
Man, I think that leads us right into the next slide here, which is choosing the wrong team. See, so when you choose the wrong team, it could, it says right here, it could cost you thousands,
Yes.
and it could cost you, the difference between having a pre-approval for 300,000 versus 350,000. Maybe I don't know that actual scenario, but I know having an extra $500 on your debt to income.
Makes
that
a big difference.
And so one thing that I want to say, again, we've talked about it being an extreme seller's market. And a lot of you may have already been shopping for homes in this market, and you've noticed that you look on Zillow or MLS one day and you see a new house come on the market, then the next day that house is already under contract. That's an extreme seller's market. So what you want to do is make sure that you have the right team available to be able to take you out to look at properties. And even as a team here at the Kirby Group, I'm not always going to be the one that takes you out to look at the property. My job here is to negotiate contracts and make sure that I'm getting you the best deal for the least amount of money out of pocket. But ultimately, my job is to make sure that you win. And that's what this market is about. It's about winning. But we do work as a team here. So what we're going to do whenever you're available to see a home, if I'm not available, I'm going to make sure somebody's on my team available to show you. I tell people all the time, if you're looking for an agent that is going to tell you the difference between granite countertops and Formica, or help you pick out paint colors, I'm not the agent for you. My job is to save you money. And then if you need somebody to help you with that, we have people on the team that can help you. But my job is to negotiate contracts and save you money. John's job is to make sure that your financing is in place and that we close on time. We have an excellent track record. Me and John, I think we're up to maybe 5 years together.
Yeah.
That we have personally been working together. We've helped many, many families close on homes. And so we would love to give you the information that you need to be successful in closing on homes. But you have to take the first step. The only thing that we can do is we can give you the information. We can hold you accountable to what it is that you say. But ultimately, you're going to have to take this first step. And what is that first step, John?
You got to apply.
You got to apply.
And you have to see where you are. That is, we can talk about it. You can tell me all about it. And I love listening to those stories and things like that. But at the end of the day, I got to see it.
We got to see it. And documentation beats what? Conversation.
Documentation beats conversation. And I think, too, you and I as a team, but we have teams as well, right?
Absolutely.
So the things don't stop because we're sitting here having a conversation. I have a team of people behind me who are helping me and looking at things and preparing your loan for underwriting. And they're to answer questions, right? And so it is not, this is not a one-man shop, right?
Absolutely. And which is very important. Again, in this market, we want to make sure that you're getting the best possible consultation and conversation available. But we also want to make sure that we're getting to you in a timely fashion, right? And so that's our job. And especially, again, in this market where homes are moving very, very quickly, we want to make sure that you're able to see the homes that you want to see when you want to see them. The last thing I want to say, again, please continue. We're going to be here for maybe 15 to another 30 minutes after answering some of the questions in the chat. I'm super excited about you guys taking the first steps to home ownership, tuning in with us. All our information, is here. We're available for you guys to answer any questions that you have. I know sometimes even do this live thing, even after the 30 minutes that we stay over, you're going to lay down tonight or you're going to wake up in the morning and you're going to have other questions. Feel free to reach out to us anytime and we will definitely get those questions answered for you.
Absolutely. Thank you. It's been a pleasure. Can't wait to talk to some of you guys. Thank you.
Absolutely. Thank you guys so much for tuning in to the Playbook to Home Ownership. My name is Richard Kirby and this is the Honorable John Muhammad.